The collapse of the United Kingdom might spread to countries like Japan, who's just had to intervene into its currency markets. We've got the Netherlands, with much more pension fund debt than the United Kingdom. People like Michael Burry are calling for another 50% crash. Jamie Dimon of Chase says we're just going through the other half of the hurricane. That part is still ahead of us. We've got calls almost daily of another 20 to 30% decline in the stock market coming from whether it's BlackRock or Ray Dalio, all of them cohesively arguing that more pain is to come. Even hedge fund managers like Bill Ackman are calling for more pain to come. And a lot of this pain is driven by the 10-year Treasury yield, which of course is driven by the actions of the Federal Reserve. And while over the last few days we've seen some initial talk about when the Federal Reserve is expected to give us their November 2nd 75 BP hike, then maybe a 50 BP hike, then maybe a 25 at the beginning of next year, to finally a no hike position as we finally wait for services inflation, largely driven by the inflation of rents, which take like 6 to 9 months to actually start seeing downsides. Well, folks, we know that a lot of the short-term rallies we might be seeing in the stock market could be just that, short-term bear market rallies. And while we haven't seen large capitulation yet, more pain could still be ahead. And the question really then is, when do Treasury yields peak relative to when the Federal Reserve pivots? And how does that line up with our market today? So in other words, can we look at history and try to understand, when the Fed has pivoted in the past, even though today they're going to be, or this market, they'll be pivoting for a different reason, right? In this market, they'll be pivoting for basically responding to inflation coming down, which is great, because if we didn't have inflation, we wouldn't be going into a recession. This is a Fed-forced recession to drive inflation down. We've been talking about this on this channel since January. And so while there are differences, it's worth looking at history to see, can Treasury yields give us a hint in terms of when they might peak relative to the Fed's hiking cycle? And does that give us a little bit of insight in terms of when to potentially buy Treasury bonds? When is the bottom for the Treasuries market to where it's time to finally get into TMF, like the triple leverage Treasury fund? Maybe it's time to take the money from my startup House Hack, which if you're an accredited investor, you could join. Just go to househack.com. Make sure you join by October 31st. You can get more details again at househack.com. But anyway, we're going to take our funding and throw them into treasuries as well. When is potentially the peak of yields? And while not always directly correlated, the stock market often suffers when treasury yields rise because the risk premium for the stock market changes. In other words, if you're expecting a 7% return on the stock market, why would you take the risk on the stock market if you could get a 4.5% return on a 10-year treasury? And if you're living in a state like California, you're exempt from California state taxes for those treasury bonds. So you're really getting a tax-affected return of closer to 5% investing in a treasury. Why bother taking the risk for an extra 2.5% or 2% in the stock market when you could get essentially a similar 5% in the treasuries market? It's absolutely insane. It doesn't make sense, especially if there's potentially another 20% downside in the markets. So, what kind of research do we have today? Well, today we have research from Barclays, and it gives us a little bit of an idea as to the timing of when we might actually see yields peak, which I actually think is good for two reasons. One, the stock market, but also two, it'll probably give us an indicator of peak pain for the real estate market, which is critical for House Hack. All right, let's go ahead and jump over. So here's the chart. 10-year yields have started to rally only 2 to 3 months prior to the end of the cycle. Now, when they say yields, I really think they mean 10-year bonds. They say that, in my opinion, in a little bit of a confusing way, but it makes sense when we actually look at the chart. So let's understand the chart a little bit and try to understand how much could Treasury yields actually go down. All right, so let's do this together. First, what you want to know is that the black line is the average. And I think it's worth looking at the black line, but it's also worth looking at 1983 because that's a previous time where we saw a treasury yield skyrocket because the Fed was fighting inflation, right? So I like the dark blue line. I like the black line most because it's the average. So let's go ahead and see what we have. you could see those treasury yields really spiking a lot in that dark blue line because we were fighting inflation, right? And so what's fascinating is the fall of treasuries, that is yields. Yields tend to go down. Bond prices tend to go up about 2 to 3 months before the end of the cycle. And you could see that roughly here, where almost everything kind of starts trending down, right? All of those years start trending down. You get sort of the black starts trending down over here, the average. And when do we think that might be? Well, if we think that the Federal Reserve's final rate hike will be in March of 2023, which is the current expectation that rates are going to go up to March, peak out, and then start flattening or maybe potentially rotating down, then if peak is March represents T0. January would be 2 months prior to that. So we might actually see a peak of treasury yields and a peak of mortgage rates sometime around January and December, which if right now we're over here in October, it means we potentially, especially as we fight inflation more, we could still see a rise in treasury yields. We saw that in 84 and 83. We saw that over here and sort of the average via the black line. So we still have some rising yields ahead of us. So maybe there's not, according to this chart, necessarily the biggest rush to get into treasuries yet, unless, of course, we think the Fed is going to stop raising rates in January. Then we would probably hit a peak in November. But right now, the market seems to be pricing in that we're looking at some kind of peak in March for the Fed hikes. That means a January peak for treasury yields, and it's possible that by December, January, we could hit something remarkable like a 5% treasury yield, which would be amazing because if House Hack puts $25 million into 5-year 5% treasuries, I mean, we'll be making over $1.1 million for a year doing nothing, which is absolutely insane. And again, my goal with House Hack is to make sure we do the best for our investors because that's the most important thing, and my reputation is on the line for that. So how much do yields then fall 6 months later? So maybe by August, September of 2023, how much could we expect yields to fall, and how much of a heads up could that give us for the real estate market, right? Well, what's fascinating here is I drew these little pink lines at the 50 basis point decline and the 100 basis point decline. So if we hit a peak of over here, let's say 5%, and maybe over here where the zero line is something like 4.25%, right? Let's go ahead and draw that here. Let's say that this peak is 4.25% right here. Okay, so then we would expect that by August and September, right here, 5 to 6 to 7 months later, we would be somewhere over here in this region, and that would represent somewhere between a 50 to 100 basis point decline. So let's call it 75 basis points. That means we might see 10-year treasuries still sitting around 3.5%. Unfortunately, when the 10-year treasury was sitting around 3.5%, we still had mortgage rates in the neighborhood of 6.5%. And if we end up trending with high mortgage rates and high treasury yields like this for all of 2023 and potentially into 2024, the real estate market is going to suffer quite substantially. Now, I hope that you take advantage of the opportunity to build your wealth by learning and getting educated in real estate via the links down below and the courses on building your wealth through real estate investing and stock investing. But what this thing here is, what this beautiful thing here says, is that we have the luxury of time. There's really no potential rush because it's not likely that even though treasury yields went up kind of like they did over here in that light blue line where they skyrocketed because of the disaster of the Fed's quick hikes, it looks like they kind of more slowly bleed out like a meme stock, in that it could take all of 2023 to just go down a measly 75 basis points off of 4.25. Now remember, they could go up to 5%, but that's more of like this sort of remarkable gyration over here that I don't think will last. But the point is, the odds of based on this historical chart, us seeing treasury yields under 3% again anytime soon seems remarkably low, which means the pain for real estate is likely to last for really years to come. But it also tells us a little bit about the stock market, that the stock market, if it aligns with peak treasury yields, in other words, when the stock market is at bottom, treasury yields are at the highest the bottom of the stock market, according to this chart, will either be 2 months before January, when the Fed stops hiking rates, or 2 months before March. I'm leaning more towards 2 to 3 months before March. That would be somewhere around January, maybe late December, but probably January, in my opinion, for some form of a bottom. Now, I don't really want to call that because, quite frankly, we could be at a bottom right now. There's a lot of stress that usually happens right before an election, but I don't think we're necessarily in a position where we could really have sustained bear market rallies until we really get closer to that pivot phase. Generally, the bottom of the market aligns pretty closely with when the Fed finally does pivot. Now, in case you're confused by that because you saw a chart on the Federal Reserve pivoting and how stock markets have actually fallen more, what I want you to do is go expand the description in the links down below. Open up the video where I write the myth of the Fed pivot and watch that video. It's a full explanation for you, and I think it's really important and really educational to watch. And that's my goal, is to bring you perspective and education that others aren't, because I know it's easy to make fear-mongering and clickbaity titles and intros, but if that fear-mongering continues throughout a video and the perspective is always just fear, 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 it just becomes unrealistic. My belief in this market is actually one that the United States is going to have far superior success weathering this recession compared to any other country in the world, and that's why our dollar is so strong. And I don't want to not be investing in the United States. I think I'm going to look back in 10 years and go, I can't believe I started a housing company at the bottom of the market. I can't believe I threw everything I had into the stock market at the bottom, right? And it doesn't necessarily have to be right at the bottom. It can just be sort of in lower territories. And I think that'll pay off extremely fruitfully in the long term. So my thoughts. Thank you so much for watching, and good luck out there.